प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the headlines tonight. Third day of gains in stock markets, buying in banking, realty, power and FMCG shares, lifting the Nifty 118 points, Sensex up 385 points to regain the 57,000 level. Big relief for those using online transactions. RBI defers tokenization by 6 months. Will not be launched from the 1st of January. Unprecedented warning by government about some Edtech companies. Says companies are targeting the vulnerable families by using free services to activate EFT and auto debit features. Market leader Hero sets the ball rolling for two-wheeler price hikes. Says increasing commodity prices has forced it to increase prices by up to 2,000 rupees from 4th of January. Havells issues a warning on price hikes in the consumer durable market. Says AC prices could go up by 5 to 10%, while other products will be costlier by up to 5%. And even as plans to introduce tokenization from the new year spooks merchants across the country, Business Today brings you a special report on how your online and card transactions will change. In a major relief for online and card transactions in the country, the Reserve Bank of India has deferred tokenization by 6 months. Tokenization will now not be implemented from the 1st of January. RBI had proposed to implement tokenization to make online transactions safer. However, various stakeholders had expressed difficulties in implementing the process. Tokenization involved getting a virtual debit or credit card number and submitting that to the merchant or the online website instead of your own card details. Karishma joins in with more on the story.
Well, absolutely. It looks like an early Christmas or a happy new year in literal sense, with the Reserve Bank of India now extending the card tokenization deadline by 6 months to June 2022. You know, this is the second extension that's come in because it was ideally supposed to be implemented in March 2022, but the Reserve Bank of India had pushed it to September following to January 2022, that is for the coming new year, and now it is pushed to July 1st, that is after June 30. 6 months of extension. I'm going to read out one of the most important paragraphs that also says by the Reserve Bank of India that in addition to tokenization, industry stakeholders may devise alternate mechanism to handle any use case or post-transaction activity that currently involves or requires storage of card-on-file data by entities other than the card issuers. Well, you know, this move comes after the digital payment companies along with banks and merchants and industry association had put in this request to Reserve Bank of India that they will need an extension. Now, had it been implemented as per the current level of readiness or preparedness that you call it, this RBI mandate would have definitely resulted in a lot of disruptions, especially on the revenue part. In fact, Business Today TV also spoke to one of the industry associations who said that the revenue loss expected is of about 20 to 40% for the small and the medium merchants, and it's also going to be difficult for individuals in a span of 10 days to adapt to this new kind of technology. But 6 months makes it well enough time for the industry to think, and with that to also derive an alternative mechanism as mandated by the Reserve Bank of India.
Another good day for the markets, with the benchmarks closing on a positive note for the third straight session. Gaining around 385 points, Sensex reclaimed the 57,000 mark. Nifty also rallying 117 points to get back to the 17,000 mark. Gains in energy, financial and FMCG shares pushed headline indices higher, while Power Grid and IOC logged in over 3% gains. ONGC, ITC and Bajaj Finance also rallying over 2%. Pharma names like Divi's Lab and Sun Pharma came under selling pressure. Other laggards included JSW Steel, Bharti Airtel and Ultratech. And keeping up with the IPO rush, MedPlus Health listed on the stock exchanges at a 30% premium over issue price. The listing came in line with the strong demand seen in the grey market. The 1,400 crore rupee IPO received a strong response as it was subscribed about 53 times. India's largest two-wheeler manufacturer, Hero Moto, is raising prices from the new year. The company has announced it will hike the prices of its bikes and scooters by up to 2,000 rupees from the 4th of January. The reason it's given for this decision is higher commodity prices. Nearly all automakers have announced an increase in prices from the new year. Consumer durables giant Havells has warned of a price hike in the near future. In an exclusive conversation with Business Today TV associate editor Chetan Bhutani, the company chairman and MD said that prices of ACs could be hiked by up to 10%, while that of other electronic goods will go up 5%. Havells has invested 500 crore rupees in setting up a new factory in Rajasthan.
Cost increases, what all segments could see the price hike, and what all by how much percentage you are anticipating a price rise?
Well, I think air conditioning itself may see a 5 to 10% increase in the coming season because the cost increase has been more than that, and not the entire cost increases have been passed on to the market. One of the reasons is because of the pandemic in the last 2 years, the offtake had been low. But we are hoping for a better season in the coming times, and eventually some of the costs will have to be passed on.
Except air conditioners, any other costs that you're expecting to pass on, like in washing machines or televisions or geysers, any other products?
I think pretty much some of the costs have been absorbed, some of it have been passed on. We may see a little bit of price increase up to 5% in some other product categories as well.
With the finance minister wrapping up her pre-budget meetings with stakeholders from various sectors, all eyes are on her speech on the 1st of February. While the economy is seeing green shoots of recovery, the rapid spread of the Omicron variant of COVID may spoil the party. So what will be the government's priority? This is what Business Today TV's Chetan Bhutani asked Niti Ayog's Amitabh Kant.
The budget is around the corner. What are your key expectations? You have been a part of the integral discussions with the Honorable FM. What do you think would be the focus? The capex, the budget spending on infrastructure. What do you think would be the key focus?
The country needs to grow at high rates for a long period of time. It's not just this year that we need to grow at 9% plus, but on a long-term basis, and that would require both capital expenditure as well as consumer demand to grow. And our investments on capital expenditure side will give a thrust to consumer demand in the long run.
The central government has warned parents and students against free services being offered by some companies offering online education. In an unprecedented caution against Edtech companies, the Ministry of Education has said that some of these companies are luring parents in the garb of offering free services and getting the electronic fund transfer mandate signed or activating the auto debit feature. In a series of do's and don'ts, the ministry has asked parents to avoid automatic debit option for payments. There's also a warning against letting the Edtech companies track subscribers by using their IP addresses. Another big do is asking for a tax invoice statement as well as doing a thorough background check of the Edtech company. Parents have also been asked to activate parental controls and safety features on the child's device. Another warning is about forced sign-up for education packages. Among the don'ts, do not blindly trust advertisements, do not sign up for any loans you are not aware of, do not install apps you are not confident about, do not give more personal data than needed. Do not share personal videos and photos, and the big one, don't trust success stories shared by the Edtech companies without proper checks. As the buzz around Tesla launching its vehicles in India gathers steam, sources have told Business Today Television that the central government has given permission for 2 models of Tesla. The Model 3 and Model Y can be the first Tesla models to enter India. Chetan Bhutani gets you an exclusive report.
World's largest electric vehicle manufacturer, Tesla, was recently given approval for 7 models. Business Today Television has exclusively learned from sources that the Ministry of Road Transport and Highways has given approval for 2 new models. Model 3 and Model Y. In all, a total of 7 variants from these two models have so far got approvals, which includes 3 variants of Model 3 and 4 variants of Model Y. Sources say Model 3 Long Range, Model 3 Performance, Model 3 Standard Range Plus, Model Y Standard Range, Model Y RWD, and another Model Y long range vehicle with minor changes have been approved. Tesla is still waiting to launch its electric cars in India. The US-based electric vehicle maker is still in talks with the centre to reduce import duties on electric vehicles before entering the market. The Model 3, which is the entry-level EV in the Tesla lineup, is the most likely model to come to India first. Elon Musk in July this year had earlier tweeted about high import duties and also said clean energy vehicles are treated the same as diesel or petrol, which does not seem entirely consistent with the climate goals of India. India currently demands custom duty ranging between 60% to 100% on imported cars. India imposes 100% import duty on fully imported cars with cost, insurance and freight value over $40,000, while 60% duty is imposed on cars that cost less than the amount. Earlier, Niti Aayog CEO Amitabh Kant had said that Tesla's import duty cut is under consideration of the central government. Even as the government works on getting Tesla to India, the company has not given any confirmation on the timeline to launch its vehicle in India.
You're watching Ask Udayan, the show where we answer all your questions on stocks. I'm Abha Bakaya. With me, our global business editor, Udayan Mukherjee. A very difficult time indeed if you're an investor to try and assess the right strategy, with markets being fairly volatile, a lot of uncertainty with regards to the way things are going to go. And this is really when you need to reconsider how and where you invest in the stock markets. Let's start off with some of those queries. Remember, do keep sending them in to the number on your screen. We'll select a few and answer them on TV and online every Wednesday. Mayank Singh from Kolkata has a question on CAMS. Let's listen in to exactly what his query is.
Hello then, I am Mayank Singh. So I've been holding 20 stocks of CAMS bought at about 3,000. It had gone up to 4,000 and came down back to 3,000 and hovered around 3,000 for quite some time. But now it has fallen considerably below 3,000. When do you see a reversal happening in the stock, and also are fundamentals all right with CAMS?
Yeah, I think CAMS is a good company. I mean, as you know, since you have been tracking the company, it's India's #1 mutual fund registry and transfer agency, and it's a two-player market. CAMS and Edtech are the two players, and CAMS is by far the dominant player in mutual fund registry and transfer. It's a stable annuity kind of business. I mean, as the mutual fund business grows, as more and more people buy mutual funds in the country, you will keep getting a regular income stream for CAMS. So that's a very good a bread and butter business to have. But what's also interesting now is CAMS is getting into the account aggregator business, which means that financial data providers can go through CAMS to provide the data to financial data users. So this bridge between data providers and data users is something which might pay off. I mean, it's a new business for them, but in the days to come, in the years to come, I think it might be an interesting place to get revenues from as well. So overall, it's an interesting business and a good play on capital markets and mutual fund penetration in the country. And it's a duopoly, so I don't think profits is an issue for CAMS going forward. The only issue with all of these companies, mid-cap companies, which are fundamentally good, are that valuations had got terribly extended. So as you said, I mean, it went to 4,000, but now it's come off to about closer to 2,500. Still trading at about 40 PE multiple, so it's not cheap yet. But the good thing about this correction which is unfolding now is that many of these very lofty valuations will skim down to entry points where you can consider owning them. So I think CAMS, to cut a long story short, is a good business and it's a good story to back. And maybe this correction will give you a better price point to average your holding. But I think it has the makings of a long-term proposition.
Okay, Siri Das has also sent in a query from Dubai, and this one is on Yes Bank. Go ahead.
Hello, Mr. Udayan. This is Siri Das from Dubai. I have around 2,000 shares of Yes Bank. The average buying price is something around rupees 375 per share. Just I wanted to know how long I have to hold these shares, or I should buy more to average out the price, or it is better to get rid of. Thank you.
I'm not terribly gung-ho on Yes Bank. I know that a lot of cleanup has happened on Yes of its balance sheet, and I think they're trying to put the past behind them, and it's a difficult past. But you've seen what is happening with banking stocks right now. I think they are under considerable pressure, not least because of the kind of very high FII holding that the sector enjoys, and that is working against them at this point in time. But the way the sector has underperformed, I think it's better to look at some of the stronger franchises in the private banking space rather than look at Yes Bank. Particularly so if there is some kind of a COVID wave, fingers crossed on that, and things get sticky on the asset quality front once again, you would not be wanting to hold on to subpar franchises in the banking space. So, I mean, if you had to look, I think you are better off looking at the ICICIs and Axis of the world rather than looking at something like a Yes Bank. It is not as bad a proposition as it was 6 or 9 months ago. I'll grant you that. But I still think there are difficulties along the way.
Rakesh Sachdeva also sending in a query from Kanpur, and this time it's on one of those tech stocks.
Hi Udayan, nice to see you. Udayan, I am holding some technology stack like TCS, Infosys, Tech Mahindra, L&T Infotech and L&T Technology Services. And I am holding these shares for the many years. And after this recent surge in the stock market, the total weightage of my technology shares holding has become almost 20%, 25% of my total portfolio. I want to ask you a question that should I keep continue my tech holding as technology seems to be a good bet for the next 3 to 5 years at least, or should I switch to a part of it to some other sector like infra, etc. If you suggest switching, please recommend sector of your choice also. Thank you.
No, I don't think there is any pressing need to switch sectors. I understand the anxiety for having such a lot of your weightage in one sector, but I think there are very strong tailwinds in the technology sector now. You've got excellent stocks in your portfolio. I mean, one cannot pick a better technology portfolio than you have picked. And having done that, I think maybe it makes sense to stay put. The only technical risk to technology right now is that FII seem to be in sell mode, and FIIs hold a huge ton of technology stocks. For some reason, if they start to lighten their portfolio, you might see some kind of short-term blip in the stock prices. But I think fundamentals are very strong. I mean, you've seen the recent Accenture results and the upping of their guidance. I mean, they've upped their revenue guidance from between 12 and 15% to up to 19 to 22%. I mean, that's as big a jump in guidance I've seen from them in recent years. So I think this whole cloud migration story is a real one, and there is a lot to go along that. And therefore, I would not ditch high quality technology stocks in a hurry at all. I think you have a very decent portfolio, and it is, as you said, for the long term.
S. Pratima of Bengaluru also has a query on Bharat Forge. Let's listen in.
Hello. Holding Bharat Forge 200 shares, bought at the rate of 748 per share. Need to know its growth, whether to hold or exit.
You know, Bharat Forge is a good company. It has a very good management. The Kalyanis are very good promoters. And it is not a one-trick pony. I mean, everybody thinks of Bharat Forge as a pure auto ancillary play, but they have a fairly significant non-auto business as well, the industrial business, which actually is doing quite well once again. On the commercial vehicles front, which continues to be their bread and butter, I think things are looking up quite considerably, and they have some decent order momentum on the commercial vehicles front. On the non-autos, as I said, they're doing well again. Passenger vehicles is still a little bit of a drag, but they are making some interesting moves on the electric vehicles or electric cars as well. So I think it's a good portfolio for an ancillary business. Next couple of years, if you look at it together, I think they should be clocking on an average about 30% kind of growth, earnings growth, which is not bad at all. Valuations have moderated. The stock is no longer at 900 odd. It's trading, I think, below 700. So it's no longer a very expensive stock. It's trading at 22, 23p multiple. I would even go to the extent of saying that Bharat Forge probably is better than most of the auto stocks that you can own at this point in time, given the kind of growth expectations we can have.
That's all the time we have for on this edition of Ask Udayan. If you have any queries, simply share them with the number on your screen. We'll take a few more of those stock-specific queries next week here on the show.